Using the following year-end information, calculate the current ratio and the asset ratio. All right, so we're going to need the current assets and current liabilities as well as quick assets or asset assets. So let's calculate that first. I'm going to say current assets, and we have to decide of these which ones, of course, are current. And of course, cash is current, short-term receivables is current, accounts receivable is current, inventory is current, as well as prepaid expenses. So they gave us all these current assets. Things that would not be current would be if they gave us something like property, plant, and equipment. So I'm just going to put those here. I'm going to bring those numbers down: 38,600, 9,000, 40,000, and 2,400. All right, and 17,400. And so the total then would be here. I'm going to go and sum that up. I'm going to underline, home tab, font group, and underline, and just add those numbers up. Those numbers adding up to the sum equals the sum of this plus this plus this plus this plus this, giving current assets of 345. Now let's do current liabilities. So current liabilities then would be just the payable and the other current liabilities. So those are the current liabilities. Long-term liabilities would be like long-term notes and stuff like that. So they didn't give us any of those, so we're just going to say, all right, so we got the 22,300. And if we sum that up, underline total, the total current liabilities then would be the sum of those. And so if we were to calculate then the current asset ratio, we would just take the current assets divided by the current liabilities. So that's going to be equal to the current assets, this 345,000 divided by the current liabilities, 1,095. And so that's not quite 3 because we need to add some decimals. We do that by going to the home tab, numbers, and increasing the decimals. 3.15, it's a little bit longer than that, but we're going to round it to 3.15, which Excel will do automatically like so. Okay, so then the quick ratio or the acid test ratio is the next one we're going to have. So they call it the acid test ratio. And it's a similar ratio, but it's going to be more restrictive in terms of the assets, meaning it's going to include cash. Well, let's just do the acid assets or quick assets. That's the thing that differs. So we're going to say that the current assets are going to be more restricted. We're going to have cash, we're going to have short-term receivable, we're going to have accounts receivable, but we're not going to have inventory and we're not going to have prepaid expenses. So I'm going to copy these and say these are the more restricted assets in our ratio that we will then calculate. And so we're going to sum those up. Those are our asset or quick assets. And then we're going to have the acid ratio, ratio. That's good enough. All right. And that's going to be the same, it's going to be the same current liabilities, but we're going to have the current or quick assets or the asset assets divided by the current liabilities. So that will give us 1. We're going to go up to the home tab, we're going to go to the numbers, and we will add the decimals on that. So note that, of course, the current ratio is always going to be higher, and that's because we're trying to see how many times we could pay the liabilities off with the current assets. But the quick asset's going to be more kind of restricted, and that's going to be more, I guess, conservative in that we're going to restrict the assets to things that are closer to cash, more liquid assets. Next one says that a company's current assets are 23,920, its quick assets are 14,090, and its current liabilities are 12,270. Its acid test ratio equals what? So this one they actually just gave us the numbers. It's just a matter to know what the ratio is, and the ratio for the acid test ratio are going to take the quick assets, which are the more restrictive assets, which don't include inventory. And that they say had quick assets of 14,090. It's always going to be less than the current assets. And we're going to divide that by the current liabilities. Let's say current liabilities, which were 12,270. So we then will take the 1490 quick assets over divided by 12,270 current liabilities. Then we need to add some decimals, so I'm going to go up to the Home tab, the Numbers group, and add decimals like so. 1.15. Again, it might be a little bit longer, but we're probably going to, most problems will, take it 2 places out like so. Next one says that corporation's quick assets are 1,111,000. Its current assets are 13,260,000, and its current liabilities are 1,136,000. Its asset ratio equals what? So same thing. We just got to know what the asset ratio is. So we're going to take the quick assets. It's going to include the quick assets, which are less than the current assets, 6,111,000, and we're going to take the current liabilities, which are quick assets, current assets, and its current liabilities, 8,136,000, and we will then divide those out. So we're just going to take the quick assets divided by the current liabilities, and it's not 1, it's going to be Home tab. I'm going to the Home tab, going to the Numbers group, and we're going to add some decimals, and we get 0.75. Now this one's interesting, of course, because we have the current liabilities are greater than the quick assets, meaning we can't pay off the current liabilities with our quick assets. It's less than that. Also note that if we're dealing with these big numbers and you're talking about ratios, of course, we can knock off these 3 zeros in a ratio if we wanted to do it a little bit faster. If we have a time constraint, it'd just be 6,111, knock off the 3 or divide by 1,000 to both sides, 8. So we have here, we've got the 8,136, and if we divide that out, then we should come up with the 6,111 divided by the 8,136. Once again, adding the decimals, Home tab, Numbers group, adding decimals, and we get the 0.75 once again. Next one, company had cash sales of 95,525, credit sales of 84,200, sales returns and allowances of 2,200, and sales discounts of 3,975. Net sales for the period would be what? So it's important here not to confuse net sales and net income. So net sales, remember, is basically the sales minus the contra sales accounts, which includes sales returns and allowances and discounts. So if we were to calculate this, then we could take the sales amount, and they gave us 2 sales numbers, so we can subcategorize that and say we had cash sales, which is part of sales, of 95,525, and we had the credit sales of, that's the 84,200. That gives us total sales, and so sales is the sum of the cash plus the credit sales. So that's our sales amount. Now we have the sales returns and allowance. Returns and allowance, I'm just going to abbreviate like so. That's going to reduce sales. So that, I'm going to put that in as a negative in this case. Reducing the sales 2200 and the sales discount. Sales discount, that's going to be the discounts we gave to our customers, negative 3,975, and that gives us net sales, not net income, net sales. I'm going to go ahead and sum these up, and as we do sum that equals SUM, it's this number minus this number minus this number, because those are in there as negatives if we were to put it into a calculator, giving us the 173,550. Now note that these amounts here are contra sales accounts. They basically act like expenses in that they're going to reduce the net income as well as the net sales at the end of the day, but they're basically kind of contra sales and they're up in the sales area. Next one says that a company's net sales were $716,900, its cost of goods sold was $243.30, and its net income was $55,900. Its gross margin ratio is what? Okay, so to do that we have to figure out first the gross margin. The gross margin will be the sales minus the cost of goods sold. So our most important relationship generally if we sell stuff inventory. So we're going to take the sales number, which they gave us to be 716900. We're going to take the cost of goods sold number, which they gave us to be 243030. That subtraction problem will give us the gross profit. That's the gross profit, and we'll subtract those out. That's going to be the sales 7169 minus the cost of goods sold 24330, that gives us the gross profit. I'm going to underline that. Home tab, font group, underline. Now to figure out the profit, the gross profit margin, we're going to take the gross profit divided by the sales. So I'm usually put that next to the gross profit. And I'm going to say that equals the gross profit divided by the sales. And I'm going to go ahead and go to the home tab. We're going to go to the numbers group and add decimals on that. Like so. And we could also, it's also in the form of a percentage. If we move the decimal 2 places to the right, we would then get a percentage. And if we want one more decimal, depending on how it would be formatted, 66.1, or, you know, as many as we want. We only need one, apparently. And there we have it. So basically, for every sales that we make, we're kind of going away with every dollar. We're going away with 66 cents, basically. That's going to be the gross profit ratio.